Assalamualaikum. Assalamualaikum, sir.
जी वालेकुम अस्सलाम। बस रिकॉर्डिंग ऑफ अभी फिलहाल मेरे ख्याल से बच्चे allow me to
Um, yes, I'm just interested to have a brief introduction about the CMA as a program because the Kagiso and the Shoaib Sab are new in this particular program.
please
So
please
I will be taking few minutes only.
okay please
Just a second, please. Okay, so Shoaib Sab and Kagiso, so basically this particular program has a two parts, as you all know. First one is the financial planning, performance, and control, and the second one is financial decision making. Next, the exam structure basically is that you will be having two parts in your exam. It will be an online computer-based exam having 100 MCQs and two essay questions. And in the essay question, normally there are 4 to 5 subsections or sub questions. Normally they gave two case studies, and in those case studies they ask around 4 to 6 questions from that particular case study from the course content basically. Okay, and the duration of the exam will be 4 hours. 3 hours will be for the MCQs exam and 1 hour for the essay questions. Okay, so we have basically three exam windows: January, February, May, June, September, and October. And you can attempt any part, part one or part two in any sequence. Then another important point is that, for example, if you want to attempt exam in February, then you have to register for the exam 15th day before the first of that particular month. For example, if you want to attempt for the February, so I believe you have to register 15th day before the first of that particular month. All right, so this is the part one basically, and we will be starting part two, which is strategic financial management, and it has 6 sections or parts. Section A basically contains financial statement analysis. Then part B, section B is related to the corporate finance, and decision making is the section C. So basically, these are the three major sections containing 65% weightage in the overall exam structure. 20% is relating to the financial statement analysis, 20% for corporate finance, and 25 for the decision making. Then 10% goes to the risk management, investment decisions, and the professional ethics. So this is the overall bifurcation of the syllabus basically for the CMA part two. All right. So once you will pass all those parts, so at the time of membership or to get the certificate, it is mandatory that you have a graduation degree in any discipline and 2 years of continuous professional experience. All right. So this is a brief introduction about the program basically. Now over to you, sir.
okay. Thank you very much, Mr. Abdul Shakur, and I welcome Kagias and Shoaib.
Yeah, Kagisu has raised the hand. Yes, please, Kagisu. Is
I
there any
guess
question?
he's saying very good. He did thumbs up.
Okay, okay, okay. All right. So we have Faizan Sab has joined.
Okay, okay.
Let me check that. I believe he has joined. All right. Yes, we have Faizan Sheikh Sab from Saudi Arabia. So Faizan Sab, welcome to the session. And can you please introduce yourself?
I guess he's still like not joined yet. His mic is not joined. He is in the process of joining. Yeah, he has joined now. Mr. Faizan has joined. So Faizan, would you please introduce yourself? Faizan Sheikh. Faizan, can you hear me? Okay. Yeah, Mr. Abdul
We can
Shakur.
hear you.
Yeah. Appreciate if you briefly introduce yourself, your educational background, and your current position.
Yeah, sure. My name is Farhan-FCA, and sorry, I was connected with the phone. Just give me a moment. Sorry.
Faizan, I guess you have two devices. Yeah, there was some echo. Nile has also joined. Nile or Nail, how should we pronounce?
I think he or she is having another name and he's joining from another device.
Nile. Yeah.
Sorry for this. This was my kid's laptop. I just connected. Am I audible?
Yeah, sure.
Great.
So please introduce yourself.
So this is Faizan. I'm actually based in Riyadh.
Okay.
My qualification background is I'm CA Inter and MBA,
Okay.
and I've been in the Middle East for last 12 years. My current job is in Gulf Catering Company as a finance director.
Okay.
And I think I'm just looking forward to just to have another wing on my shoulder, I guess.
Great. Good, Faizan. Appreciate. In fact, studying is always appreciable to improve yourself, and especially in terms of the qualifications. These definitely help in your professional career. Wonderful, Faizan. So I guess we should not wait anymore. We have already, in fact, late almost 20 minutes. It was, in fact, an introductory session today, as well as, like, since it was a very first day, otherwise 4 o'clock Pakistan time would mean 4 o'clock. And in between, there will be a break around, like you can say, after 1 hour. That would be a break for Maghrib prayer over here. And then our session will end at 6 o'clock Pakistan Standard Time. So in a way, it will be a session of 2 hours with a break of almost 10 minutes in between. As Mr. Abdul Shakur was introducing the subject to you, and in this subject, the very first section A is about the financial analysis. I'll start from this section A, and today I'll try to cover maximum part of financial analysis, and which I will go through in my next session, means tomorrow, as well, the remaining part of this section. There are 3 units in this section for financial analysis or financial statement analysis. In all those 3 units, the concept of financial statement analysis is discussed with lots of practice material. I'll try my level best to give you this concept with the help of certain numerical figures. And the very important thing which I must emphasize today, which will remain with you forever, that practice at your part is a must. If you will not practice, or if you will not be able to practice whatever I'll be discussing with you, trust me, this professional examination will be lost. So this is something you have to discipline yourself, and then to focus on the concepts and to do practice. Your book is sufficient for all these practices. And mainly, let me give you a very important tip over here, that these professional accountancy examination will become very easy to pass when you would be excellent at your concepts. So please feel free to discuss the conceptual issues with me. And if you are not clear on that, don't let me go forward. Okay. So by this, we will definitely, inshallah, achieve a very good result in the very first attempt. And that very good result is pass. Okay. Well, so as all the participants in this course definitely would be having accounting and finance background, so they would be familiar with most of the basic accounting things. And the beauty of this course, CMA Part 2, is that in this course you would be having amalgam of financial accounting, financial management, and to some extent management accounting as well. The section that we are going to take up right now, financial statement analysis, is in fact the end point of the financial accounting and is very important area of the financial management, financial analysis or financial statement analysis. When we say accounting cycle in a financial accounting, it starts from the financial information. If there is no financial information, we do not need financial accounting. And its ending point is financial statements in absolute terms. From here starts the need of financial statements in relative term. So the concept of absolute term and relative term is very important. The financial statement in absolute term, I have given you an example over here. These are the financial statements in absolute term. Statement of profit loss, which is also known as income statement. This income statement is presented in absolute term, like in currency unit: sales, cost of goods sold, gross profit, operating expenses, till your profit after tax. So all these are the information that you are seeing over here are the information in absolute term. Means independently they have their own value. But when we relate any information on another information, that becomes relative term. Like cost of goods sold is 60% of the sales. Gross profit is 40% of the sales. This operating expense is 10.7% of the total assets. Okay. So this is in fact a relative term. So relative term means we are relating an absolute information upon the another absolute information. Why do we do like this? Because mostly what we see that if there are two organizations having absolute firms, sometimes their absolute information misleads the users of the financial information. For example, if you see over here, the two entities, company A and company B. Company A is having a sales of 80,000 and B is having a sales of 200,000. A is earning a profit of 1,600, B is earning a profit of 20,000. Obviously, we'll say that this B is earning a good profit, so it means this B is running excellent. But this is what we are saying on the basis of the absolute term. When we translate this absolute term into the relative term, what we see that company A is earning a gross profit, which is 20% of the sales, whereas company B is earning a gross profit, which is 10% of the sales. So it shows that company A is doing much better than company B because the profit percentage is double of the profit percentage of B. So this is the importance that how we analyze the financial statements in relative terms. I just talked about the users of the financial information or the financial statement. Remember that there are basically three primary users of the financial statements: investors or owners, lenders, and creditors. Investors, obviously, the shareholders, the members, the owners of the entity. Lender, who have financed the entity based on a loan. And creditors, who in fact supply goods to the entity and are expecting that entity will make payment of the amount due to them. These basically are the primary users. Other than these, you can say that customers are also users of the financial information. Managers of the entity, means the employees of the entity, are also users of the financial statement. Government agencies are also users of the financial statement, blah, blah, blah. So all these are like the users of the financial statement, but primary are the investors, lenders, and creditors. So as I've already introduced to you, the financial statements are expressed in absolute and relative term. In the relative term, we see the financial statement is analyzed vertically, horizontally, and based on some ratio analysis. These analyses are in relative form. Also, we find an analysis in terms of cash flow analysis, which is straightforwardly a statement of cash flows in which we analyze the cash flow in absolute term, dividing those cash flows into three sections: operating, investing, and financing. The section A of your syllabus covers vertical analysis, horizontal, and ratio analysis only, which are in the relative form. Vertical analysis is also known as common size analysis. And in this analysis, we see that the balance sheet items, means statement of financial position, balance sheet items are analyzed based on the total amount of assets. So based on means we are going to work out an information or a ratio which is on relative terms. In the same way, the income statement, statement of profit loss items would be analyzed based on net sales. Again, this is in relative terms. Just for the sake of clarity, let me give you an example over here, that this is a balance sheet in which you can see the assets over here bifurcated into non-current and current assets. This is total assets. Then equity and liability part, in which share capital and reserves, and liabilities, non-current and current liabilities are there. And you see the total equity and liability, 35,440 is equal to total assets, 35,440. Okay, how we will be translating this balance sheet from absolute term into the relative term based on the vertical analysis, which is also known as common size analysis. That is, we will base the amount of total asset for calculating percentage of all the items over the total asset. Like, okay, one thing very important for all of you, that be attentive while I'm discussing, with your calculators, your pen, ballpoint pen, and scratch pad or notebook. If you will not be attentive with the help of all these gadgets or the necessary tools, then you will be losing whatever I'm emphasizing, whatever I'm working for you, because this online session will only be useful when you are attentive. Otherwise, if you will think that, okay, I'll take the recording and I'll cover the backlog, forget about it. You will never be able to get benefit from the recorded lectures if you are not attentive during the lecture, if you are like connecting on real time. So please be attentive with your calculators. So now I'll ask you to use your calculator. And one thing more, I would like you to interactive with me for each and every point. You can say yes or no. You can ask me to repeat. You can nod for anything that you have understood. Okay. So by doing so, you will enjoy your learning. Well, so calculate the percentage of property, plant, and equipment over the total assets. Just do, and at least the 3 items that I have encircled, calculate its percentage and do confirm that all these percentages are correct. And I would like to hear from you now. Kagias, Mohsin Mukhtar has also joined, Shoaib, Faizan. Please be interactive with me.
Yes, all the percentages are correct.
Okay, great. So it means that we have understood that when we are analyzing vertically in terms of a balance sheet or statement of financial position, we will be basing on the total assets. Okay, one thing more, Kagias, I'll appreciate if you will interact through your voice, because when I'll be reading the messages in the chat box, it will be merely a wastage of time. Okay, and it will like distract my motion. But when you will be interacting with me through your voice note, that I will appreciate. Okay, so these are few things that we will take care in our relationship of almost a 10 weeks time period. I want you to learn excellent level of this subject, and that I ensure you that if you will remain interactive with me, your learning will be very high, inshallah. Okay, so the next thing is, in the equity also, since I have told you that total asset of the balance sheet are equal to the total equity and liability, one thing I'll tell you over here, that this total equity and liability is also known as claims. Why we call it claims? So in a way, we can say the assets are equal to the claims, because all these are the financing which has a claim over the asset. So by the way, since all the claims are equal to the asset, so what we do, we calculate in this vertical analysis each single individual upon the total asset or the total claim. You will find all these ratios correct. So this is the vertical analysis of balance sheet. Then comes vertical analysis of the statement of profit loss or the income statement. So in the income statement, as you can see over here, that sales figure will be the base. Here, the asset figure was taken as a base for calculating all the percentages, whereas in the income statement, the sales is taken as a base for calculating percentages of all the information in the income statement. Like, for example, you can take any figure like other income and just see or the distribution cost, just calculate it and make yourself confident that yes, it is percentage of the sale exactly. Same is the case with the comparative year. So this is simply vertical analysis. What I can do, just to give you a confidence, I can show you your book. This is what we are in fact learning, the liquidity solvency leverage ratio, in which this starts from the common size financial statements. And over here, there is a simple example, exactly the same as I picked up, only the numbers are different. Sales less cost of goods sold, gross profit, less selling expenses, and general administrative expenses. These are in fact known as operating expenses. We get operating income. Other revenue and gains means other income. Other expenses and losses minus. You get profit or income before taxes, then income tax, and you get net income or profit after tax, whatever the terminology you use. So exactly the common size format or the common size income statement, you see the net sales are 100, cost of goods sold, this means 1650 is 91.7% of the sales, 1800, so on and so forth. So exactly the same thing. And over here, for the balance sheet, you see your total assets are the base for each and every calculation. Being base, it is 100%, okay? And each individual information in the balance sheet is worked
Excuse me,
out.
sir.
Yes, please go ahead.
Which slide you are discussing? I cannot see the slide.
You cannot
I
see.
guess we are not able to see. I think we're still looking at the balance sheet.
Oh, hold on. In fact, it was not the screen that I was sharing. Now tell me, can you see this book?
Yes, sir. Now it's
Yes.
okay.
Okay, I'm sorry. Earlier there was the only window which I shared. Now I have shared the whole screen. So in fact, this is the part of your book. Okay, I was discussing your book, in fact. I trust you have downloaded your book with you. Am I right?
Yes, we did.
Yes, sir. Yes, sir.
Oh, good. So this is all about what I have discussed with you so far from the vertical analysis. So now you can see this working sheet with you. I've like
Yes, sir.
to this working. Now I'll be discussing horizontal analysis. Horizontal analysis is further split into 3 types of analysis. By the way, this is known as trend analysis. This horizontal analysis covers change analysis, in which we work out percentage change based on the previous year, then chain analysis, and then index analysis. I'll take you through the numericals and then I can come back to this formula side. Like, for example, in terms of change analysis, you see. So the change analysis, of course, we have 2 figures with us, 17 and 18. In the 17 year, just you use calculator and see how much the difference we have from 18 to 17, like 86,320 minus 75,200, okay, divided by 75,000 the previous year. So the current year minus previous year is the change divided by the previous year into 100, you get the percentage change from 17 to 18 or from previous to the current year. I'll ask you to work out just administrative expense as well on your own, please. Do it yourself. So what will be the numerator and what will be the denominator? The numerator would be the difference of the 2 figures and the denominator would be the figure of the previous year times 100 will give you a percentage. I'm confident that this
18.9.
is correct. Okay, so that's it. All right. So in the same way, you would be like doing percentage change for all the income statement figures. And if I take you to your book, in the book, the vertical and horizontal. Now I trust you can see your book part. Am I right?
Yes, sir.
Good. So vertical and horizontal analysis. In vertical analysis, we did percentage based on the above, but that's why it's known as vertical, and horizontal, we go like horizontally. Okay. In your book, by the way, this vertical and horizontal, especially the horizontal analysis, was discussed very shortly. What I am discussing with you contains little more detail. Therefore, I'll take you to my notes once again. And now because in your book, they simply said that if you are comparing your horizontal information, means with the previous year, so it's a horizontal analysis. I have elaborated this, that horizontal analysis can be chain or index analysis. So change analysis, I have done with that. Chain analysis means you have a chain of like number of years, say 15 till 2020. So we'll make a chain 15 upon 19, 19 on 18, 18 on 17, 17 on 16, and 16 on 15. So what you will do, pick up any information, like you can do this chain analysis for the sales, for cost of goods sold, for gross profit, for profit after tax, like anything. Okay, as I mentioned over here, any information you can pick and make a chain. Just put the absolute information here and calculate. You can work out in times, or you can work out in percentage. Just use your calculator and calculate your this 2020 on 2019, like 4,000 divided by 2,500. Just see, you will get 1.6 times. And when you will multiply it with 100, you will get like 160%. Do let me know.
Yes, sir.
Yes, we just did.
Great, mashallah. Wonderful. Then comes index analysis. Index analysis is like, here you base on one single figure and then make an index. And like, for example, here we make this percent or the fraction on the previous year. Here the fraction will be worked out based on 1400, the figure of 2015. So what the analysts do, they rate 1 year as a base year and keep on analyzing their success stories or their issues of the current year on that base year. So 2016 upon 1400, 2017 upon 1400, means 1500 upon 1400, 1000 upon 1400, so on and so forth. So just work out 2 or 3 calculations, you will find the result. Okay, so this is known as index analysis. Okay, if it is fine, I'll move forward. Okay, before I start discussing the ratios or the ratio analysis, although you will say that this is very basic thing, but let me talk basics, because when you are working on your concepts, your basis should be 100% strong. For the sake of like our calculations, we will be assuming that we are working for a company structure or a corporate structure in which we are having shareholders or equity holders or the stockholders as the owners. Okay, and we will be having an owner's equity based on all these shares plus the reserves, which could be like retained profit or any other reserves. So this is what like I in fact discuss over here, that what is included in owner's equity. So the owner's equity includes the share capital that we receive from the public, okay, and the share premium when we receive in excess to the face value. So although it's again basic, but please don't mind if I'm discussing the basics. The basic accounting entry for this is that we have received cash, the finance from the owners, and that finance, if it includes a premium, both will be your owner's equity items, giving credit to them. When you earn a profit, remember, when I'm saying you, please rate this diagram a value. Here, this is you, okay? Being an accountant sitting in the entity, this is you. Okay, this is an entity for which you are doing accounting. And these are the shareholders, what I'm talking about. Plus, all others, like the lender, the customer, the supplier, they all are the employees, okay? They all are the third parties, okay? So you are interacting or doing transaction with all these people. Among those, like shareholders are also a group who are not within the entity, rather outside the entity. So entity is the first party. Shareholders are the second party, and all others are the third party. That's why we call sometimes third party receivable, third party payable, like that. Anyways, so owner's equity, when we say owner's equity, it covers your profits, out of which we create reserves, okay? And the dividends are the distributions that we in fact pay to the shareholders or to the owners. So these are the simple accounting impacts that you can see. By the way, I can't interrupt this thing, it was just a discussion there, right? Okay. Okay. Now I'll move forward to the next part, which is I'll take it like at first level profitability ratio. The order could be like changed, like in your syllabus, it was set as liquidity and solvency ratios. Again, I'll take you to your book. Here, they start with the liquidity and solvency ratios. By the way, then they will talk about profitability and per share ratio, and then activity ratio and the earning quality. One thing I noticed, might be you would have also noticed that in your folder, the name of this liquidity, the unit 1, it was wrongly written as, I don't know, I don't remember now what was the name. I guess some other name was written over here. Financial markets and financing, I guess it was the name which was written with the unit 1. So please change this with the liquidity, solvency, and leverage ratios, unit 1, 2, and 3. So I'll take you to the unit 2 first, then we will talk about the unit 1 and then unit 3. So it is just an order that I am following. It is not something in which like rigidity can be seen or not. Anyways, before I start my discussion on profitability ratio and solvency, liquidity, working capital ratios, and long-term solvency, efficiency, and this is how I divide all the ratios into 5 categories. So before I start my discussion on these ratios, I'll take you through the parts of balance sheet. In fact, when we say balance sheet, it revolves around this accounting equation. Very basic. Assets are equal to owner's equity plus liability. okay, where we can subclassify our assets into current and non-current assets, and the liabilities into current, non-current liabilities, and owner's equity. One thing again, very important, owner's equity is not a liability, remember. If you have, for any reason, in your mind that owner's equity is a liability payable to owner, it's a false concept, wrong concept. Liability means an obligation. The entity does not carry any obligation to pay back to the owners. It is not an obligation. Yes, liability is an obligation. So owner's equity and liability both are the claims on the assets, but owner's equity is not an obligation, remember. So this liability is bifurcated into the current. Yeah, if someone wants to say something, Mike. Yeah, Faizan. Okay. Well, so liability is bifurcated into current and non-current liabilities, and here's owner's equity. So what we can do, we can like take this non-current liability and owner's equity at one arm of the equation and take your current liability at the second arm of the equation, so that over there you will find current assets minus current liability, which will make your working capital. So the balance sheet equation would then be non-current assets plus working capital equal to capital employed, because owner's equity plus non-current liabilities are the capital employed. And in our finance section, we will also call it as capital structure when we will be discussing the finance part. It is also known as capital structure. Okay, now I'll take you to this balance sheet, which is a conventional balance sheet. Here we see non-current and current assets together. We get total assets. This yellow circle is showing total assets. This include like non-current assets, investment property, your fixed assets, your intangible assets, your long-term investments, long-term advances, deposits, prepayments, etc. And current assets include inventory, trade receivables, blah, 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 whatever comes over here. And owner's equity, share capital, and retained earning, basically. Liabilities, non-current liabilities and current liabilities. Current liability include creditor accruals, etc. If you have any point to discuss, please feel free to discuss even the basic concepts, because if you would be good at your basic concepts, I would be good in my speed. Okay, so please don't mind to ask any basic question. Well,
Yes.
So yes, please.
Yes, yes. Sir, I just have a question, sir. On the left side, this capital employed. The schedule, yes, this is it. Yeah. I would just like you to highlight a bit more, especially the last, the non-current asset plus working capital equals to capital employed.
In fact, the thing is, it's a mathematical equation. When we say non-current assets, current assets minus current liability, mathematically it is equal to the owner's equity plus non-current liability. Since this owner's equity and non-current liability is the amount of capital employed in the entity as a finance to run the show, therefore the other side of the equation is also named as capital employed. So we can have three formula for capital employed. One formula, non-current asset plus current assets minus current liability. Second formula, non-current assets plus working capital. Third formula, owner's equity plus non-current liabilities are the capital employed. Why we need to know that there are three formulae through which we can work out capital employed? Just because we have to attempt an examination and examiner plays smartly with the examinees. Sometimes you will see that missing information. So what you can do, you can maneuver with this basic accounting equation, and you can work out the thing smartly. Then whatever is missing, you can locate the thing from there. Okay, so capital employed is a very important equation that we should master into, that how we can work out the capital employed thing. So Faizan, please let me know if the question has been taken correctly.
Yes, correct. It's understandable now.
Okay, good. Thank you. So in the same way now, based on your question, I have restructured this conventional balance sheet into the capital employed balance sheet. You can see over here now. Just focus on this highlight on this pointer. So we have like assets over here, in which non-current assets and current assets are there. Now we have dragged our current liability from down to up. So when that current liability will come up, it will be subtracted. You will get the net of these two, which is known as working capital. So the non-current assets plus working capital is giving you a capital employed figure of 2,500. So we can say there are two formula you can use for capital employed. 2,300 plus 500 minus 300 equals to 2,500, or 2,300 plus 200 gives you 2,500. Means non-current assets plus working capital gives you capital employed, or non-current assets plus current assets minus current liability gives you capital employed. Next, the lower part, the claims part. Here we have share capital and retained earnings, which is 1,500, your owner's equity, plus non-current liabilities only, because the current liability has been presented at the upper part. And now we have only two items to present over here. And you see your both sides are equal in terms of like mathematical calculation. Okay. So this is how we can present our balance sheet in conventional way or in capital employed style. Another thing I'll discuss quickly, and then we will take a break for Maghrib prayer over here. Yeah, it's statement of profit loss or income statement. Okay, here we start from sales minus cost of goods sold, get gross profit, we get operating expenses. This is the sum of like selling, distribution, marketing, and administrative expenses or general expenses. Altogether, when we subtract this from the gross profit, we get operating profit. Then we add other incomes or other gains, etc. We get profit before interest and tax. Remember, in American style, only the terminology is different. Rest of the information is calculated exactly in the same way. Like they call it as gross income or gross profit or gross margin. Then they call it like operating income or operating earning. They call it as earning before interest and tax. Okay. Then financial expenses or interest expenses, you subtract, you get profit before tax or earning before tax or income before tax, whatever, the concept should remain the same. Then income tax expenses, subtract, you get income after tax or earning after tax or profit after tax, whatever. So the format does matter, remember, format does matter. I'll take a break, and during my break, I will leave this screen open to you. You can have a discussion session among yourselves. Here you will be seeing blue line, blue arrow in a way, which is relating operating profit with the total assets. Then green is relating profit before interest and tax with the capital employed. No matter it is calculated using this formula or this formula, both remains the same. And the yellow is relating profit after tax or earning after tax with the owner's equity. And here I have capital employed thing, okay, working capital thing, all this. So this screen will remain open to you, and I'll take a break of 10 minutes for Maghrib prayer. And let's resume with our lecture. By the way, do let me know if anyone has any point to discuss over here. As far as like I can see, Mohsin and yeah, Mohsin joined late, I guess. Rest of the Shoaib, Kaigiso, and Fizan, they were
Yeah,
there. So
I joined half an hour late, so probably, either you can repeat that half an hour or I can catch it up from the
okay.
recording and I'll
So,
get it. And
what? Yeah, please. The thing is that in the first half an hour, we just had an introductory session, and Mr. Abdul Shakur, in fact, introduced the course and the layout through which, like, we would be covering our sessions. And by the way, can you let me know that what I was discussing when you joined? What was the point I was discussing at that time? Like vertical analysis or horizontal analysis?
it was vertical analysis.
Okay, then you did not miss anything.
I joined from this slide.
Yeah, Okay, so like it was the very first thing that I discussed in terms of like your academics. Rest of the other things we were discussing, like the basic things of the syllabus or the course or something like. In fact, initial 10-15 minutes we just did wait for others to join. But like appreciate if everyone joins on time from like next onwards. For Pakistan Standard Time means for Pakistan Standard Times, okay? Because the time is very limited to cover the things which are extensive, and I want to make each and everything very means extensively or deeply. I would like to discuss with you so that the concepts are clear, and the clarity of the concepts in fact helps you to pass the examination. Therefore, please, next time we will all observe the time, and inshallah, I trust things will be in our control in terms of the examination. Well, as far as the point I was discussing before leaving for the break, there was the relationship of operating profit with the total assets, relationship of PBIT with the capital employed, and relationship of profit after tax with the owner's equity. Why I'm saying relationship? When I say relationship, it means the owners having equity in the entity will not be looking at the gross profit figure. They will not be looking at the operating profit figure. They will not be looking at PBIT or PBT. Rather, they would be focusing on the profit which is meant for them. That is profit after tax. So it gives you a ratio. What is that? Profit after tax divided by capital employed. In the same way, the people who have financed the entity are in fact the shareholders and the lenders. Shareholders have provided equity and lenders have provided the finance. Altogether, it is known as capital employed. So these people, they look, means the people who have provided capital employed, they look to the profit before interest and tax. So they are interested in the profit from which neither the interest has been paid nor the tax has been paid. So the ratio is like capital means profit before interest and tax divided by capital employed. Okay, this is owner's equity, I'm sorry. Okay, and capital employed. So, and in the same way, when we say like the total assets means the total claims, which also include the current liabilities. Okay, again, these are in fact the asset, the equity and the lenders and the creditors who are having claim on the total assets. So they will be focusing on the operating profit, because this is the profit now in which they all are having attraction the greater this profit, they would be more satisfied. So here we have another ratio, which is return on total asset. So the thing is, by doing this, we are done with these three very important ratios: return on total assets, operating profit divided by total assets, obviously into 100 we'll get a percentage, return on capital employed, profit before interest and tax divided by capital employed, return on owner's equity, profit after tax divided by owner's equity, times 100 we get percentage. So this is how we relate a profit to the capital employed, owner's equity, or the total assets, or the total claim, you can also say. But like, although it is total claim, but examiner calls it total asset, so that the ratio is return on total assets. Okay. Technically, it is total claim. Well, so over here, in fact, these are almost the 9 or 10 ratios, whatever you can count, which cover the profitability ratios. Gross profit margin. When we say margin, it is on sales. When we say markup, it is on cost of goods sold. Means gross profit can be measured in terms of margin or markup. The gross profit, which is measured in terms of margin, is a percentage of gross profit on sales, and the gross profit, which is measured on as a markup, is a percentage of gross profit on cost of goods sold. Then the things are easy, because the terminology which is used over here is that we have to calculate operating profit on sales. Okay, profit before interest and tax on sales, profit before tax on sales, profit after tax on sales. So we can very easily, being an examinee or the student of this topic, we can easily have a concept of the ratios of profitability, that these are about the calculation of profit loss items on sales, or the three items of the profit. By the way, return means profit. Okay, almost all of the people who are attending this course are the professionals, and mostly you sit with the decision makers, or mostly might be, you would also be a decision maker for the domain that you are having as your responsibility. So you know very well that this terminology return is used for the profits. What is ROI? Return on investment. Okay, so return means the profit, return on total assets, return on capital employed, and return on owner's equity. So profitability ratios are done. Then comes short-term solvency ratio. When we say short-term solvency ratio, I bifurcate it into two: liquidity and working capital efficiency ratios. Okay, liquidity means, in accounting, liquidity means cash position. Okay, so we see how much strong our entity is in terms of having liquid resources with us. So for the liquidity ratios, we calculate three ratios: current ratio, quick ratio, and absolute liquid ratio. As it is obvious from the name of this ratio, absolute liquid means we would be focusing on the cash and cash equivalent figure. So for all these, the denominator is current liabilities. For all these, the denominator is current liabilities. So the current assets divided by current liability, quick assets divided by current liability, and the cash and cash equivalent divided by current liability gives you liquidity ratios. One thing very important, that current assets, as I've listed down over here, current assets cover inventory, prepaid expenses, trade debtors, short-term investments, other receivables, cash at bank, and cash in hand. Well, important thing over here is that inventory and prepaid are not taken into the quick assets. Reason, because prepaid expense will never convert into cash, remember. Against the prepaid expenses, you will receive some benefits, or it will adjust some expenses in the future period. Whereas inventory will not at once be converted into the cash resources. Firstly, at first stage, it will be sold out, which will be giving you the trade receivable, and then you would be receiving cash from the trade receivables in the second stage. That's why we do not take inventory and prepaid expenses in the list of quick assets. So the quick assets are mostly debtors, short-term investments, other receivables, bank, and cash in hand. But traditionally, what we say that current assets minus inventory is quick asset. Traditionally, we say like this. But I'm giving you the complete concept, which will give you the clarity that what is this quick asset in fact. Well, absolute asset is the cash and cash equivalent, the cash at bank, cash in hand. It is absolute liquid asset. By the way, absolute liquid asset also include very short-term, highly liquid, readily convertible into cash investments if these are having original maturity of less than 3 months. We can also count this short-term, very short-term investment into the cash or cash equivalent thing. Anyways, next comes working capital ratios. Do let me know if you have any question on it. By the way, I'll solve some numerical, but I'm just discussing with you the basic formulae. Well, working capital ratios, also these are known as efficiency ratios. These are 3 plus 3 plus 1. I'm saying like this. 3 are the basic ratios, which are the efficiency ratios, means turnover ratio for inventory, turnover ratio for debtors, turnover ratio for creditors. The next 3 are the you can say number of days in sales, okay, number of days in inventory, number of days in your creditors. This is also something which reflects the efficiency of working capital management, and through this we get able to calculate the cash operating cycle, which is also known as working capital cycle, like days in terms of like inventory. If the entity is having longer holding inventory, it's something bad, means the entity is not able to sell the inventory in shorter time. The shorter is better, obviously. Debtors turnover ratio, again, shorter is better. If you are having shorter collection period, it is better because your entity is able to collect debts or debtors quickly. And creditors payment period should not be too large, rather should be manageable within some time. So what you do in fact, from the inventory holding period, and debtors collection period you get operating cycle. Inventory holding and debtors collection period gives you operating cycle. These are very important from your MCQ's point of view. And then operating cycle means from these two, we subtract creditors payment period. So that the net result of these two equals to cash cycle. All right, so wonderful. There's a small numerical, but I'll appreciate if we open our own book and look into the numericals from our book. By the way, the things are pretty much easy and solved over here. Return on total asset, return on capital employed, return on equity, current ratio, quick ratio, okay, inventory turnover ratio, debtors turnover ratio, creditors turnover ratio, and their period. Altogether, these are worked out over here from the basic data given in this question. I'll take you through your own book and we'll see what so far we have covered. So liquidity ratio, as I was introducing to you, that these are the total assets. By the way, resources is a terminology that we use for assets. Assets, okay? And capital structure, as I've discussed with you, that these are the claims, the debt and the equity. And debt means the liability, and this is owner's equity, which is like split into these two. And then comes basic balance sheet, in which we have certain current and non-current assets. And this is, you can say, assets and the claims. The finance are the claims on the assets. Current and non-current liabilities, then shareholders' equity, and here you get the total claims. Now, this is the income statement: sales, cost of sales, gross profit, selling, general and administrative expenses means operating expenses. We get operating profit, operating income, other incomes. We get earning before interest and tax, interest expense, we get earning before tax, income tax, we get net income. Exactly the same with the change of few terminologies or nomenclature. Rest of the things are 100% same as I have discussed with you. So it's saying that we have to focus these two statements in throughout the examples that we would be doing in this study unit. Okay. Liquidity and solvency ratios, although I have discussed with you, I'm just giving you a cursory overview of this unit. Current assets, current liabilities, okay. Net working capital is current assets minus current liabilities. Current ratio is current assets divided by current liabilities, okay. So simply you will be working out quick ratio, means quick assets, cash, marketable securities, net receivables. So it did not include the inventory and the prepaid expenses, okay. By the way, did we have prepaid expenses here? Let me see. Yeah, okay. So this is what I was telling you, that these are not included. Okay. So cash and receivables altogether. Okay. So current ratio, etc. Quick ratio. Okay. Other quick liquidity ratio means cash and cash equivalents. As I told you, the marketable securities come under this. So these are absolutely liquid. Few terminologies would be changed, but that's what, like I'm saying, that you should be focusing on the concepts. But remember, the terminologies which are written in your book are important for you from examination point of view. So net working capital ratio is like the working capital that you have over total assets. It's net working capital ratio. For liquidity of current liabilities, just go through the things, then come solvency ratios. Okay, let me take you through the solvency ratio through my own working. Okay, these are the solvency and efficiency ratios that I'll discuss with you. So in this, we would be focusing on the capital employed part, means owner's equity and the debt. So what we do, in fact, the debt ratio is total debts, means total liabilities over total assets. Debt equity is debt divided by equity. Gearing, debt divided by debt plus equity, or simply we can say debt divided by the capital employed. And then comes interest cover ratio. Okay. So you can work out the things based on, again, data given in this question, but I'll take you through your own book. But at the same time, let me discuss a few more things. Like, so long-term solvency ratio, total debt ratio, as I was discussing over there. These are the basic formulae given here. One point, mostly students for financial analysis, they confuse that, look, there are so many formulae, how to learn it by heart? I simply say there's no need to learn it by heart. Remember what we have so far discussed, you would have learned. Like, I gave you 9 formulae for profitability ratios, out of which like 6 are simple based on the sales, and rest of the 3 are simply return formulae, means profits. You just have to relate the profit with the relevant information. So you are done with 9 formulae. Then liquidity ratios, all upon, say, current liabilities, sorry, all are on the current liabilities. Liquidity, current assets, quick assets, or absolute liquid assets divided by the current liability. You are done with the 3 formulae again. Then 3 plus 3 plus 1. This is about turnover ratio. So when you are calculating inventory turnover, inventory belongs to the cost of goods sold divided by inventory. When you are calculating debtors turnover ratio, it belongs to the credit sales divided by debtors. When you are calculating creditors turnover ratio, it belongs to the credit purchases divided by the creditors. Okay. So you just need to relate the information. It's not, again, cramming. It's something your attentions will make it easy, and clarity of the concept will make it easy. You're calculating inventory. It has no concern with the sales or gross profit, etc. Directly, inventory belongs to the cost of goods sold, and cost of goods sold belongs to the inventory in terms of their efficiency. debtors and creditors. Debtors belong to the sales and creditors belong to the purchases. Simply you will get through. And when you are calculating their number of days, the ratios that you have calculated, like 365 divided by this ratio, inventory turnover ratio, you will get inventory holding period. 365 divided by debtors turnover ratio, you will get debtors collection period. Or 365 divided by creditors turnover ratio, you will get the creditors payment period. Or there is another formula to work out these ratios, which is very simple. Again, from the student point of view, the ratio that you use for calculating the inventory turnover, that was cost of goods sold divided by inventory. For calculating the days, you can say that inventory divided by cost of goods sold per day. So simple. You will get days. Then for creditors payment period, creditors divided by purchases per day. By the way, you would need to reflect the smartness in your numericals. So you must know that how alternatively you can calculate these period time. And then inventory, I'm so sorry, it was debtors collection. Debtors, you are not making me correct. It means you are not attentive. You should have pointed out. Debtors divided by sales per day. Okay. Debtors divided by sales per day. And inventory days, you can calculate inventory divided by cost of goods sold per day. Are you all with me?
Yes, sir.
Yes, sir.
So I need your attentions, please. Okay. So this is how alternatively we can calculate the inventory holding period or debtors or creditors period, and then the operating cycle and the cash cycle things. So again, why I came back, just to give you a confidence that learning these ratios is not hard. It is simply make your concepts, you will get those ratios. Like I just put number over here, 9, 10, 4, 3, 5, like almost 31 ratios you have to learn. So the thing is that 10 plus 9, 19 ratios, we have done with this. Rest 4, 3, 5, I'm just going to give you once again. These 4 ratios are total debt ratio, simply total liabilities to the total assets. We are just calculating what is the relationship of our total liabilities over the total assets. So owner's equity is not included in this. It's total liability only. Then debt to equity ratio means debt divided by the equity. Okay. Debt means non-current liabilities. Capital gearing ratio, here non-current liabilities are divided by the owner's equity plus the non-current liability, which is capital employed. So we just see, like, just look over here. Just look over here in this figure. Say if you have this simple balance sheet with you, 200 assets, owner's equity is 100, non-current liabilities 80, current liabilities. So we are playing with this 180 in these 2 ratios. Like debt equity, we are playing with 80 and 100, 80 over 100. Capital gearing ratio, 80 divided by 100 plus 80. All right. So very simple. Whereas total debt ratio, we work out total liability. This is total liability over the total assets. So 100 divided by 200 gives you 50%. So things are not complex, simple. You just need to focus, and that's it. Then comes efficiency ratios. Earlier, we discussed the efficiency relating to the working capital items, which were inventory turnover ratio, debtors turnover ratio, and creditors turnover ratio. Over here, we will discuss efficiency relating to the assets or resources utilization, like total assets turnover. All these are also turnover ratios, by the way. All these are also turnover. All the turnover ratios are the efficiency or activity ratios. So there's one more very simple concept, by the way. Whenever we are calculating turnover ratio, sales is the numerator mostly. Now I'll give you a concept here. In the ratios, debtors turnover ratio, sales was the numerator. But in these two ratios, sales was not the numerator because we cannot relate these two with the sales. Like inventory, we cannot relate inventory with the sales. For inventory, we can relate with the cost of goods sold, and with the creditors, we can relate creditors with the purchases. That's why we are not using sales figure over here. Otherwise, as a student, for every turnover ratio, put the sales as numerator. So total assets turnover ratio, sales divided by total assets. Non-current asset turnover ratio, sales divided by non-current assets. Capital employed turnover ratio, sales divided. Say if I'm saying fixed assets turnover ratio, what will be the ratio? Sales divided by fixed assets. So you can construct your own ratio. Sales divided by fixed assets. Or if like you people are in a senior position, you ask your junior resource, okay, calculate our machines turnover ratio. We just need to work out the machines turnover ratio. So what the junior will calculate? Sales divided by plant and machinery, your production plant. Now you got the concept, I guess, that turnover ratio, calculating turnover ratio, again, it's not a matter of cramming. It in fact shows you the efficiency, that how optimally you are utilizing your resources. So this is what the activity ratio or the efficiency ratio or whatever. Okay. So optimal utilization of the resources is reflected through the turnover ratios. Turnover ratios. And that's it. Okay. So you're done with how many? 9 plus 10 plus 4. Now the efficiency. Only 3 ratios. I'm sorry, you're done with this efficiency, also 3. Now the market ratios, the 5 ratios. This is market ratio. You would be familiar with EPS. Very common ratio. Earnings per share. What are these earnings? In fact, earnings available to the equity shareholders. So earnings per share divided by the total number of equity shares. So this is earnings per share. So profit or earning after tax divided by the number of paid up share capital. Number of, we just need to look into the number of paid up share capital. You'll get EPS. Price earning ratio. You will get the price from the market of your shares and divide it with the EPS per share. Both are per share, remember. Per share, per share. Okay. Otherwise, if you will go for the market capitalization, then you would be dividing it with the earnings. Okay. It means there is an alternative formula for this. I'm going to write over here. That is M cap divided by the earnings available for equity shareholders. Mostly it is profit after tax. Okay. Now you are not calculating per share figure. rather absolute figure for market capitalization divided by the absolute figure for the. So how we calculate market capitalization? That we calculate simply market price multiplied by the number of paid up share capital. So the number of paid up share capital is common over here. When we eliminate that number from here and here, we get price per share and earnings per share. So simply market price. Why I'm giving you the alternative formulae? The reason being, examiner is very smart. He plays with your concepts, in fact. So you should be having means excellent concepts for working out the ratios. Right. So in this earnings per share, what you see, that profit after taxes. When you calculate dividend per share, dividend divided by the shares. And this is price per share, earnings per share. Okay. And last thing is earning yield. Yield is always like the percentage of your earnings over the price that the shareholders will pay to buy your shares, is the price from the market. And what the earning your entity is giving to the shareholders, you will just calculate its yield. Supposedly you are paying, sorry, not paying, you are earning 20 per share and the price in the market is 100 per share. Okay, so there is a yield, in fact. Okay, so instead of like it's in fact like reverse of this PE ratio. It is price per share over earnings per share, but it is calculated in times. Okay, here in times, but this earning yield ratio is calculated in the percentage, in which we see the earnings per share divided by the price per share times 100. You get earnings yield ratio. All right, so you're done with the ratios, and now I'll take you through your 3 chapters. And okay, and few practice material I'll also share with you. By the way, this is the question, the basic question that I use for the calculations of ratios. All these ratios have been calculated. So you will spend at least 2 hours on this 2 hours lecture. Okay, if you will go through all the working that I have done with you, definitely it's your success. By the way, this is something, this can confuse you. I'll not send you this sheet. I'll send you these 4 sheets only, the PDF of these 4 sheets. You will use these 4 sheets with your 3 chapters. So by the way, over here in this chapter, we have discussed capital structure. I'm just giving you the confidence that what we have so far done. Debt to equity ratios. Okay. Debt to total assets ratio, earnings. Oh, yeah, here I trust they have wrongly written over here earnings coverage ratio. It is interest coverage ratio. It's some misprinting. Okay, so earning before interest and tax divided by the interest expense, it is calculated for. And then comes leverage, operating and financial leverage. I did not discuss this thing. By the way, I will discuss this now in my next lecture. Degree of operating, yeah, this is something I have to discuss because this we use in finance. So I'll discuss this part in my next lecture. Types of leverage. Okay. And then comes your percentage change, degree of leverage. Yeah, this is again the degree of leverage, degree of finance leverage. This is what I have to cover in my next lecture part. And what else I have to discuss? This is profitability. I'm done with this profitability ratios. Okay. EBITDA earning. What is EBITDA, by the way? EBITDA is the profit before interest, tax, depreciation, and amortization. This is a very important working, because in fact we see that depreciation and amortization doesn't play any role in working out the calculations of performance measurement of the managers. So they are simply like focusing on EBITDA thing. Earning before interest. Why before interest? Because this is the management's decision or the director's decision to take loan or not. Taxation, government or jurisdiction will impose tax. So if you are looking into the performance measurement of managers, if the entity is paying more interest or more tax, this is not something should be put on the manager's burden. And like depreciation, if the entity is like working with expensive assets, okay, the depreciation would be greater in comparing with the other entities. So EBITDA is exactly the basic information which compares the two entities, regardless of they are having different capital structure, they are working in different jurisdictions, they are working with costly or economical assets, okay, they are having intangible assets or not. So regardless of all these things, EBITDA gives you the true reflection of the operations of the entity. That's why this is very important calculation. EBITDA margin, again, EBITDA divided by the sales, okay. Its advantages and disadvantages are very important for you to learn. Profitability ratio, net income divided by sales, very easy things. Return on equity, I've discussed. Return on total assets, I've discussed. And then DuPont, yes, DuPont I will discuss tomorrow. It is a pyramid that we work out based on the ROCE pyramid, okay. Wonderful. DuPont we will discuss, and theoretical part you will learn just yourself. Just go through these areas, okay. Then factors affecting reported profitability, your income or revenue, blah blah blah. Just go through and you will discuss all your learning tomorrow with me first. Any questions that are creating confusion, you will discuss those to me. Per share ratio, earnings per share we have discussed, okay. Basic earnings per share ratio, okay, all these. Well, then comes your third unit, which is about activity ratios and earning quality. Activity ratios we are done with the efficiency activity ratios, okay. Debtors ratio, creditors ratio, you will find operating cycle here, inventory turnover ratio, days in inventory, payable, okay. Operating cycle covers your days in sales and days in inventory, and what I told you that cash cycle covers operating cycle minus days in purchase, means creditors turnover ratio, creditors payment period, sorry. So it gives you cash cycle. Altogether, it is also known as working capital cycle. Cash cycle is also known as working capital cycle. Okay, so I'm done with my part of discussion that I was supposed to do with you in my today's session. And do let me know if you have any questions belonging to my discussion sessions that I have. Yes, Kagias, Mohsen, Shoaib, and Faizan. Please do let me know if you have any questions.
So we will go through it, and inshallah, we will let you know if we will have any questions.
Great. So appreciate.
Yes, we want to learn from the book as well.
Yeah, you have to go through the book, please. Book is very important for you. Okay.
Yes.
You will
Okay,
use
sir.
you will definitely use my slides or the notes that I'll be giving to you straightforwardly. I'll send you all these notes to you right now. Okay. And please, book is very important. Book is very important. So you have to go through your book, read your book, and take your understanding out of your book and the notes. And feel free to discuss with me tomorrow when we'll have a session. Firstly, we'll discuss if there is any question, any problem. We'll discuss that, then we'll move forward. Tomorrow, by the way, we'll do some practice also from your book. Yes. Anyone else?
What time are we starting tomorrow?
The same time.
4 p.m. Okay. Thank you.
Good, great. Okay. Faizan, Mohsen.
Yes, sir. I think it's all clear. Thanks for it's kind of a reflection. We're trying to just revising the concepts we learned long back. So it's a good breather, I guess.
Brushing up your, in fact, the knowledge that you had earlier in your earlier education. So wonderful. So God bless you all. See you tomorrow, same time, 4 o'clock. Okay.
Thank you so much.
Okay.
All right.
Yeah, thank you.
Welcome.
Thank you, sir. Bye.
Welcome. Bye.